Good morning to our lovely audience out there, and welcome back to Boutiques on Wednesdays. From the entire BCI team, we remain thankful for your continued support and ever grateful. Right, the Fed paused rates for now, but they warned that they remain very hawkish. So is the pause rather a case of more cracks appearing in the US economy? With inflation coming down, some argue that we might look at a profit recession as revenue growth disappoints going forward. On the local front, to add insult to injury, SA's AGOA status is under threat, with recommendations from the US to move the AGOA summit away from South Africa, as they think we should no longer be part of that. So another word of saying we're looking at possible economic sanctions. With all these headwinds, one have to wonder if an SA multi-asset low equity fund can still achieve a very ambitious target, or rather than benchmark, of inflation plus 4. These are some of the questions you may have for our renowned award-winning fund manager joining us now, Errol Shear from Sasfin Asset Management, speaking on exactly how they continue to deliver on absolute returns, but keeping in mind risk or low volatility. Errol, it's an absolute pleasure to welcome you back again to Boutiques on Wednesdays, and really great to have you on our session. And you're going to look at the Sasfin BCI cautious fund or stable fund, which, like I said, it's a SA multi-asset low equity fund, and you've got a benchmark of inflation plus 4. Can you still reach those benchmarks?
Indeed.
Errol, you can share your screen. You're more than welcome to pop your slides up if you are ready. We are ready for you. Yeah, coming through.
Okay, I'm going to talk today about stable and defensive fund investing. What is this about? Now, if I go back to 2007, I had a cousin who was retrenched at the age of 50. He had a fair amount of money in his pension fund and also a fair amount of personal savings, and we knew at the age of 50, he was not going to get another job in his life. And he said to me, should he put his money into the stock market? And I said to him, no, it's the wrong thing for you to do. If you're 20 years old and you have a stock market major correction or crash, you can recover from it. If you're age 50 and unlikely to be employed again, you have to be cautious with your money. And I said to him, put it into what was the forerunner of the Sasfin BCI stable funds. Just as well, that was just before the great financial crisis, at which point he would have lost possibly half of his money in the stock market. Our objective is inflation plus 4% per annum. We don't care about what our competitors do, or what the actual number return is. All we want to be sure is that we are able to maintain our clients' standard of living by keeping the value of their portfolio rising in line with inflation plus 4% per annum. And we do this with the aim of having lower risk. We are looking for the more cautious investor. I'll come back to that. We have a core of fixed income assets with addition of equities, which add returns, maximum of 40% equities in line with the CISA regulations for low equity funds. We risk control both strategically and individual stock selection. I've been doing this for more than 3 decades, and we've learned some lessons along the way. Emphasis on asset allocation, and it is unashamedly designed for the more cautious clients. If you look at the right-hand side, you'll see our track record over the last almost 20 years, running this type of funds, various funds in the stable space. The gray line is inflation plus 4% indexed. The blue line is my index return of all my funds I manage in this category, net of fees. And you can see two points I would like to make. Number one, the blue line is fairly stable. The only wobble was at the start of COVID, when all asset classes came down in a synchronized way and recovered quite quickly. And the other is that over time, we actually have achieved our return of CPI plus 4% per annum. If I look at markets and how we are currently invested, the Johannesburg Stock Exchange is important to us. The long-term average of this period has been the market to trade on almost 13 times earnings. Currently, the market in South Africa trades on 11 times earnings. The South African stock market actually is slightly cheap. I know there's load shedding, there's municipality collapse and so on, but our market reflects some of those problems that we face in this country. And if you look as a stock picker, you can find numerous shares in South Africa which actually offer very good long-term value. If I look at the American market, the S&P, it's not the same story. The PE on the American market is elevated. The long-term average has been 19.5 times earnings. We are trading more than 10% above that on a historical basis, and there are concerns that there may be a reduction in the rate of growth in American company profits. And even worse, if you look at where the returns from the S&P is coming and where that high PE comes from, first of all, most of the returns on the S&P, in fact, all the returns on the S&P over the last year have been from about 6 tech stocks. That's a very concentrated position. Now, if you want to have stable returns for your clients, you do not want to have concentrated risk. The gray bars here are recessions in the USA. The blue line is the relative forward price earnings ratio of tech stocks relative to the rest of the market. And the orange line is the ratio for tech stocks versus the market on the price earnings ratio to growth ratio. Both of these reflect how expensive the tech stocks are to the rest of the market. And in fact, the PEG ratio for tech stocks is back to almost the peak we saw back at the time of the dot-com bubble. Now, most of you probably know the story of Icarus, who put on wax wings and tried to fly to the sun in Greek mythology. He flew higher and higher and higher, but eventually, as he got close to the sun melted the wax of his wings and he fell. Now, tech stocks will do that at some stage. They cannot reach the sun. We know that. If you're a momentum investor, you might do it. If you want to avoid major losses for your clients, you do not invest a big portion of your money in tech stocks. You might a little bit, but not too much. We're looking for stable returns. We do not want the risks that you see in tech stocks, despite the potential returns you have. It's just too risky for us to look at. Coming back to South Africa, inflation is rolling down. At 10 o'clock this morning, we should get the new CPI figure. Inflation is slowly coming down. Consensus is for 6.5%. But inflation is coming down. It will come down back to target of below 6%, but it is proving sticky on the downside. If I look at our South African government bonds compared to overseas bonds, I'm taking here the SA 10-year bond compared to the US 10-year bond. And you can see the differential here is about 8%. South African 10-year bonds yield almost 12%. American 10-year bonds yield almost 3.7, called 4%. That's a differential of 8%. By investing in SA bonds, which I know and understand, I'm getting an 8% better yield than I would on American bonds. I prefer the bird in the hand to the two in the bush, and therefore we have a big holding of South African government bonds. The yield curve remains fairly steep. We are picking up 3% by being in bonds. That's 10-year bonds compared to cash. So they still hold a big position in conventional bonds. Inflation link is a core part of our portfolio. Yielding, if I take the I2038, 4.8%. If we hold to maturity, we will get inflation plus 4.8%. Core part of our portfolio. If I look at the USA, the green line is American inflation. It is rolling over, but core inflation is proving quite sticky. The red line is US 3-month Treasury bill rates. I know the Fed has recently paused. There was no increase in rates last week, but there's likelihood of further small increase in American rates. So that's a story. The problem in America also is the economy remains very strong. If we look at housing starts, which came out earlier this week. They were very robust. USA unemployment remains near record lows. In my view, the American Fed has to keep tight monetary policy still for at least the rest of this year. If I look at American recessions, obviously when you have recession, it is bad for company profits and bad for stock markets. This is a history of over 100 years of recessions in the USA. On the left-hand side of the graph, in the early years, recessions were longer and very abundant. On the right-hand side of the graph, the blue lines are thinner. Recessions tend to be shorter, and there are few of them. Has the world conquered recessions through monetary policy, ability to stimulate, increase debt? Well, I'm not so sure. We haven't had a big recession for a while, and just looking at this pattern, I fear that we need to have a recession again. It is actually good for the economy in some ways, and maybe more longer lasting than what we've seen in the recent decade. If we look at the best indicator technically I've ever seen for predicting recessions, it's an inverted yield curve. This is the ratio of the 2-year US bond to the US 10-year bond. And when it goes negative, usually 10-year interest rates are higher than 2-year interest rates because there's more risk in a 10-year bond than a 2-year bond. We've now gone negative. You earn more on a 2-year bond than a 10-year bond. The inverse curve is very, very extreme. In the past, if you look at the red bars, that's recessions. Virtually every time we've had an inverse yield curve in the USA, it's been followed by recession, sometime a year or so later. On a technical basis, and it's not 100% certain, but on a technical basis, it looks very, very likely that we will experience recession, which may not be good for markets. The other concern we have on investing at the moment is a strong El Nino appears to be developing. The red line is a recent measurement of the water surface, North Atlantic Sea surface temperature anomaly. The red line, the blue is previous anomalies. And you can see that since 1982, this is the most extreme anomaly we've had, which may possibly indicate a strong El Nino developing. Why is this important? El Ninos are often associated with poor agricultural crops. Poor agricultural crops, agriculture is part of the economy, so that is a negative for world economies. It also means there could be, if history repeats, a shortage of food, which means higher food price, which is bad for inflation and not good for equity markets. So we remain on the cautious side, recognizing that we are running money for clients who are more cautious than average. If I look at the positioning of the Sasfin BCI stable fund currently, it is positioned as you'd expect. Equity 23.9%, recognizing that this is South African equity, recognizing that South African equity does offer some value compared to its own history and compared to international markets. I know it is reflecting the reality that South Africa is a tough place at the moment, but things may get better. And there is value in South African equities. Property, we remain cautious. We have been nibbling a bit of property, particularly selected value property stocks, trying to avoid the office space, where work from home is proving, making it very difficult for landlords. Fixed rate bonds, I said earlier, we like 20% of the portfolio. Inflation linkers, rates are extremely good at the moment and help us achieve our inflation plus targets. 21%, floating rate 10%, foreign equity 8% on the lower end of the range, because we believe that overseas markets are vulnerable to a correction. Foreign bonds 4%, making up a portfolio. But we believe this is the right mix of assets which will help us achieve our client CPI plus 4% with low risk in the longer term. If I look at an equity portfolio, it does have a big exposure in Naspers. This is a percentage of equities. We have a fair amount of Rand hedges here. Naspers, Raynet, Anheuser-Busch, and Sasol. We tend to go for lower PE stocks, and we like stable businesses. Now spurs the story. There's a massive discount to NAV. Adcock is a basic industry trading on a forward PE of below 10, a good dividend yield. In this fund, we like high dividend yields. Remgro, again, trading at a 30% discount to the value of its assets, and it has some quality assets. It owns the biggest fiber network in this country for the telcos to use. Most of us probably are using Rembrandt's fiber company in one or other way if we are watching this webinar. And the PE is not excessive. The banks look particularly cheap at the moment. APSA at the time of this has been taken out, was trading at around about 6 times forward earnings and a good 9% dividend yield. And as we saw from Standard Bank yesterday, the banks are experiencing some tailwinds. The endowment effect from high interest rates are helping earnings, while bad debts has remained fairly subdued. We are aware that bad debts will pick up, but we think that is reflected in the numbers. Net Investments, one of my favorite stocks, another one in the Rupert Group, a big 30% discount to the sum of its assets, the biggest of which is Pensions Corp in the UK and British American Tobacco, up 28% this year. Udoka Industry, a well-managed niche industrial company, again, low PE and a good 6% dividend yield. Anheuser-Busch to give some diversification. PPC Cement to give some exposure to GDFI, which we think will improve. Similar for Roynat. And then Sasfin on the oil space. So that is our portfolio. Our returns over time, over most periods, except for the short term, we've been well ahead of our peers. In the year to May, particularly in the month of May, we suffered when there was a correction in the inflation linkers, but we are confident that we should, well, I shouldn't say confident. Over time, we've tended to be around about 2% above our peers, and we'd like to think that we can return to that level of outperformance over time. So our Sasfin stable fund, designed for the cautious investor, one of the longest track records of providing stable returns to our clients. I really think an ideal fund for the more cautious investor who's happy with CPI plus 4%. We are not trying to be like Icarus and fly to the sun. We realize that markets have corrections, sometimes shallow corrections and sometimes major corrections. We do not want to risk our clients' money in high risk situations. So tech stocks in the USA, while we admit they could go higher, it is just too risky for our clients to have a high exposure there. If I look in history, a company like Steinhoff, with its balance sheet and opaque accounting, never made our list of assets. We remain on the cautious side, aiming to give our clients CPI plus 4 with low volatility. Thank you.
Errol, thank you for that. Absolutely to the point. And like I told you in our conversation earlier, I normally think that fund managers say less when their performances are good. So probably why you said less. Maybe from my side, Errol, just very quickly, and it touches on things like SA nominal bonds. You've got a big chunk to that, to inflation linkers, and I'll come back to that. But if SA bonds yields roughly at the moment, let's call it 12.5 on average, depending which end of the curve you buy, that's already higher than your benchmark of inflation plus 4. And if you not too excited about SA equity, still a lot of headwinds out there, then why not just hold SA bonds or inflation linkers and no equity in a mandate like this?
We could. I mean, there's a strong argument at the moment for going more fixed interest and less equity. In fact, our portfolio is biased. It has a lower equity content than normally we would have. I won't say it's a no-brainer. There are risks in bonds, which is why I like diversification. As they say, it's the one free lunch, diversification, you don't pay for it, and reduces risk. The trouble with bonds is the unexpected does happen sometimes. What could go wrong? Inflation may go higher. I do believe the Reserve Bank is doing a very good job of controlling inflation. The governor has a lot of opposition from certain economists, wrongly so. Strong monetary policy, I believe, will keep inflation under control and get it back below 6%. And our inflation actually has behaved better than American or particularly British inflation. But there's always a concern that maybe inflation will be more stubborn and interest rates may have to rise further. So there is some risk in bonds. Diversification by holding other assets helps reduce the overall risk of the portfolio.
Makes a lot of sense. A question from the audience, Tavonga at BIP, the Chief Investment Officer, and it speaks more to strategic asset allocation as opposed to tactical asset allocation. Well, first of all, it commends you as probably one of the longest standing tactical asset allocation managers in South Africa, and you've made that point before as well. But from a multi-asset class stance, looking at a multi-asset low equity fund, what have been some of the most significant changes to your strategic asset allocation framework? And then also touching on, recent offshore limits that increased to 45, did that have any impact on your SAA modeling, your starting point?
On strategic asset allocation, there's not been major change. Over 30 years, inflation linkers were not an asset class when I started off. So it's, okay, when I say relatively new, it's been tradable for maybe 2 decades or so, and a very useful asset class for our type of fund, trying to achieve inflation plus 4%. Interestingly, at one stage, we had a much higher exposure to inflation-linked bonds, but the duration risk means we cannot go, it's not from risk point of view prudent to go too high in inflation linkers. Diversification, again, very useful, very important for us. I say strategically, tactically, there have been changes, but strategically, the model seems to be quite robust. We've tinkered around from time to time, but no major changes. The changes to Regulation 28, we can go up to 45% offshore. Going offshore gives you diversification. That's the main advantage. Will it give you higher returns? I always come back to my starting points. I like to look at the numbers. And when I can get 8% more on South African bonds than on American bonds or German bonds, I have to say to myself, there's greater certainty. I'd rather take the 8% for certain in nominal terms rather than take the risk on the currency. And the rand does depreciate strongly sometimes and also appreciates. So we're unlikely to ever take advantage of the full 45% allowed in offshore assets. Just because it's available doesn't mean we have to go there. I can understand for other type of funds with different strategies, yes, go to the full 45%. But for a stable fund, I am not convinced that going 45% offshore is the right thing for our more cautious clients in Africa, particularly when our stock market is cheap relative to overseas markets. Our yields, both inflation linkers and nominals, are far, far superior to what we get overseas. Our clients are in South Africa. We understand the markets here, our cost of management low here. So I don't think we'll ever go up to the full 45%. We probably will creep up higher over time, but not to the full 45%.
Yeah, got that. Sticking to things like inflation-linked bonds, and you've indicated you've got a huge chunk allocated to inflation-linked bonds, which makes sense from a mandate perspective like that. But again, a question from Tavonga, and it speaks to the industry out there, investors and a lot of fund managers. It seems like there's a big division. You either absolutely like inflation-linked bonds or you don't like inflation-linked bonds at all. I mean, some of them just don't invest in it. Not only on the SA front, but if you look at low inflation-linked bonds as well, also trading in attractive valuations. But why is there such a huge division in views? And, are we missing something?
I don't know if we're missing anything. I mean, both asset classes we have a high exposure to. There's diversification benefits in having both. For me, for the average long-term investor, prudent investor, inflation bonds are useful. What's the most important thing is that the value of your money keeps up with inflation. The worst I've seen is when people invest over prudently. They put their money into money market funds which does not keep up with inflation, particularly after tax. And they find after 10 or 20 years of rising inflation that they can no longer afford their standard of living. It is actually very sad to see. I've seen pensioners, family members, and friends, parents, when they get to retirement age, they've been prudent, they save, and the money does not keep up with inflation. It is sad when they have to move out of their house because they can't afford the upkeep anymore. So in that case, inflation linkers, which protects the real value of the assets, I think is great. At the same time, there are some risks in inflation linkers on diversification, on the duration side. So a mixture of inflation linkers and nominals for me is the right way to go for a stable type fund.
Yeah, that answers that. Another question from our audience, and it speaks to or says, I understand your sentiment around US tech stocks, but this is the most innovative and growing segment in the world and may continue to have strong tailwinds, especially if rates were to turn over. But this compared to a PPC stock pick in a falling SA economy with a shrinking capacity for infrastructure and manufacturing, etc., etc. Your thoughts on that? You know, the whole tech argument versus then companies like a PPC or SA stocks?
Look, tech is important. I've got no problem with tech. I mean, it's going to probably improve the quality of our lives tremendously. My argument on tech around the world is that many of the tech stocks are overpriced. And there's risk in tech. It's new technologies. Many new industries don't achieve their potential from a profit point of view. Warren Buffett often mentions the airline industry. At the time of the Wright brothers' first flight, if you were told billions of people will be flying in airplanes around the world, it's a nascent industry. You should invest in it. I think most of us would have said it's a great industry to invest in at the time of the Wright brothers. History has shown, though, that it's proven over-competitive. And airlines have gone bust, thousands of them over the time. It's actually been a very, very bad place to invest. Even South Africa, Kwame, didn't do as well as expected. Well, it's been bust, I suppose. That's the extreme of not doing as expected. So often industries that are growing don't produce the profit expected. AI, generative AI, I think it's going to be great. It's going to transform our future. Will it be monetizable? Will people make money from it as investors? I don't know. Maybe, maybe not. Japan certainly looks interesting. Japan equities where growth prospects appear more elevated in SA. Japan in particular, actually, the demographics are against growth in Japan. You have an aging population, muted growth. It is cheaper. South Africa actually has some tailwinds in terms of growth. It has a growing population. The demographics are good here. I know politics have been a headwind, but with even a small improvement in the political situation, a small improvement in load shedding, which could happen next year, I think SA equities could, off a low base, could possibly perform better than some of the overseas markets.
Yeah, it can't be ignored, most definitely not. On the topic of SA equity, and we're not there yet, but it's obviously causing a lot of concerns in the market. It just talks about, SA being removed from the AGOA agreement or possible sanctions, all that translates into sanctions. People are running scared. We can see the rand also fluttering around, levels of 1840, 19 when they hear bad news. What could the impact be if we do get removed from AGOA on the SA economy and SA stocks, and more specifically, how will that influence your portfolio lookout or opportunities in the portfolio?
Okay, first on AGOA, it is important. I don't think government understands quite how important AGOA is to us. America is a major destination for our manufactured exports. To China, we mainly export commodities, and that'll go through whatever happens, maybe indirectly. I was speaking last week to one of the major industrial companies in South Africa where we have quite a big holding, and they export a lot to the USA, and I think they said they would lose the 7% benefit on sales. And they say at the moment with the rand where it is, they can still export to the USA, but if that AGOA benefit goes, it makes it kind of marginal. And if the rand does appreciate for whatever reason, it will no longer be profitable to export to the USA. I think people underestimate what it will do to exports. And if we export less, it means our manufacturing obviously takes a knock. It's bad for employment here. It's bad for tax payments. AGOA, if it goes, could be quite serious. I won't say fortunately, South Africa's main exports are commodities which won't be affected by AGOA, but at the margin, AGOA going would be a threat to many of our local manufacturing exporters.
Yeah, but I mean, if I look at your local equity carve out, mainly rand hedge stocks, and here and there financial stock like an APSA, but I mean, from what I can gather on portfolio level currently, not too much impact, I think.
Not on the high level, but there are in the tail of our holdings, we have quite a few interesting companies which would be affected by AGOA. They'll survive. They are cheap and they are well-managed companies. But AGOA again on the smaller end of our portfolio would have some effect.
But again, we can't put the cart in front of the horses. So enough of that for now. Interesting question from Spalding. Given that your CPI target, we've mentioned that before, which of your asset classes are mainly used for attaining that very high target versus asset classes used for protection? What specifically constitutes your risk management strategy?
Okay, between looking to attain the targets and for protection, don't really look at it quite on that basis. Every asset class in my portfolio, I'd like to think will help me achieve a target. If the asset class is not likely to get close to CPI plus 4, it is not a suitable asset. For protection, the diversification is important, but I really don't distinguish between attaining the target and protection. Each asset class must contribute to both.
Yeah, totally get that. And then last question from the audience. Should the strong El Nino effect, which you've mentioned, take hold, what are the possible changes you will make to your overall fund?
Okay, the biggest effect practically will be on inflation, with food inflation in particular. We don't have a very big exposure to agriculture at this point in time, so it won't require a major change. Consequential inflation, I may possibly increase slightly the exposure to inflation linkers, because a bad El Nino means higher food prices, higher inflation, more inflation linkers.
Yeah, that does make a lot of sense. There's no more open questions from the audience. I don't have any more questions for you, Errol, but thank you so much for joining us this morning. It's been truly insightful. To our audience out there, the Sasfin BCI Stable Fund is open on all the big platforms. If you want more information on the fund or the Sasfin team, or get hold of Errol, please let us know. Get hold of one of the BCI sales team and we'll put you in contact. Really phenomenal work that you've been doing with this fund. I do think this fund is obviously very underrated if I look at what you've been able to achieve over time. So Errol, thank you so much for joining us again. It was really great to have you with us. Just a short reminder for our audience out there. Next week, Wednesday, we are going to start a little bit later, not 8:30. We are going to start at 9:30 because we have our offshore managers speaking to global equity with the likes of Credo, Contrarius, Lindsell Train, and Randmore. So that should be a really good session. And that session is probably going to run for about 40 to 45 minutes, starting at 9:30, the 28th of June. Looking forward to see you again joining us for that session. Again, big thank you for the BCI team and organizing your sessions, our audience out there. And Errol, thank you again for your time this morning. We are highly grateful for that. And we'll chat to you soon.